This video will discuss and estimate the enterprise-based approach to valuation, also known as the free cash flow model. And we'll also provide two valuation examples, one with constant growth for free cash flow and another with two-stage growth of free cash flow. So recall from a previous chapter what free cash flow is. Free cash flow in a formula is earnings before interest and taxes adjusted for taxes plus depreciation and amortization, because that's a non-cash item that hits the income statement, minus CapEx, capital expenditures, and the change in net operating working capital. Now, let me go over each of these items. Earnings before interest and taxes. Let me refresh your memory here. Let's just go right to an income statement. You have sales, you have operating costs, including cost of goods sold, and you have amortization and depreciation, which is non-cash flow expense. So those are expenses, so we subtract that out, and we get earnings before interest and taxes. And then we consider interest expense, and we end up with earnings before taxes. Then we look at taxes that are paid, and we come up with earnings, or what we call net income. And so this is the earnings from operations right here, earnings before interest and taxes. And what free cash flow measures is this is the free cash flow before any payments are made to bondholders or stockholders, before any investors are paid for the money that they lent or invested in the company. So it's the free cash flow coming from operations. And I'll show you in a bit what I mean by that when I show you a balance sheet. But for now, let's look at, now you know amortization and depreciation. This was non-cash, so that's why we're adding it back here. And then, why do we subtract that CapEx? Well, in order for the company to have free cash flow, what's free? It's freely available to stockholders and bondholders. Okay, so that's why you don't subtract anything out that you send to investors, like interest and dividends. It's before that happens. So this is cash flow that's freely available to them. But you got to remember, companies need to reinvest in themselves, in capital equipment and property, in order to continue the business, to keep it sustainable. And they also need to keep up with net operating working capital, current assets minus current liabilities. So they need inventory, accounts receivable, and some cash. And we're looking here at the change. Okay, so it's kind of like an investment in accounts receivable, a little bit of cash, and some inventory as the business grows. So that's why you're subtracting these two items out right here. So let me give you another way to depict what we're trying to do here with the valuation model. So let's look at a balance sheet. You have the balance sheet of a firm, you have assets, you have liabilities, and you have equity. And what the free cash flow model does is it's going to value this side of the balance sheet, the value of operating assets. And then what we're going to do is we're going to back into equity. So what we did as an aside, I'll put it in red here, when we valued when we valued common stock with the dividend discount model, we went right in and said, look, what is the cash flows to common stock? And we answered that with dividends. And then we estimated dividends, we projected dividends, we discounted them back, and we went directly into valuing equity. So we went directly here. With the free cash flow model, we're going to go indirectly into equity. First, we value the assets of the company, the operating assets of the company. And there might be some non-operating assets of the company, which I'll talk about in a minute. And we get a value, and what we're going to call that value is We're going to call that the market, we'll call this the market value of operations. And then what we'll also add back to this is any non-operating assets that the company may have. For example, it may be sitting on a whole bunch of cash that it's really not using. It's not using it for operations. It could be that they're using it eventually for buyouts or some other situation, or they have a gigantic tract of land. Like maybe they have a tract of land up in the woods of Maine, in which it's really not part of operations. They just hold it. So you can take the market value of operations and add the market value of, I should say market value here, of non-operations. And we're not going to say much about this. This is a special category, but just keep in mind the value of a corporation, the value of the company, is equal to the market value of operations plus the market value of non-operations. And so getting back to the story here, what we're going to do is we're going to value this balance sheet, this side of the balance sheet. And we're going to take that side of the balance sheet and we're going to take value of the company minus the market value of debt, which is here on the balance sheet, debt. And we're going to divide by the number of shares of equity outstanding. And so we estimate this guy. We know what the market value of debt will be. So we back into equity in total. So this right here, this is equity in total in these brackets. It's total equity of the firm. Well, if we take the total equity of the firm, we divide it by the number of shares of equity we have, we now have an estimate of the price per share of the company at time zero. And that's the way we're going with this. So it's a more indirect way. It's very common because it's commonly used, because not all companies pay dividends. And so it's a way to get around the fact that companies don't pay dividends, especially younger companies. And so you don't need dividends. You just need free cash flow. And if you don't have free cash flow, well, you almost give up at this point because, okay, you don't have any dividends. You don't have any cash flow. You know, you got to pray, basically, in terms of valuation of the company. That said, believe it or not, there's other methods to value companies when there's no cash flow. There's no dividends, and there's no free cash flow. Those are ratio methods that I'll talk about in another video. Now, one thing I want to say here is about the dividend discount model is that, you know, and this free cash flow model, you don't have to have free cash flow right now or dividends right now to use the dividend discount model. You can still use those models even though dividends are zero for the dividend discount model and even though free cash flow at the moment is zero. And here's how to look at it. I'll show you right here. So here, if you have the dividend discount model, we estimated a stock price to be D1 divided by 1 plus RS to the 1, D2, 1 plus RS squared, and so on, technically into infinity. Well, what you could assume is that dividends are zero initially, but somewhere down the line, maybe six years from now, the dividend will be positive and the company will start paying a dividend as it matures. And then we'll discount all the dividends into the future starting in year 6 all the way out. Just that these guys are all zero initially. That's how you would value a stock using the dividend discount model, even though the company doesn't pay a dividend right now. Well, with the free cash flow model, we're going to value the company, okay, meaning the asset side of the balance sheet initially, by the same type of method. We're going to look at free cash flow next period, divide it by 1 plus. Now here's the little trick here. We're going to use not a RS because we're not valuing common stock. We're valuing the whole firm on the left-hand side of the balance sheet. So what we have to do, before I go any further, let's explain this weighted average cost of capital. It's a discount rate. And the discount rate is this. let me put it in purple here. We have to discount these cash flows here. And that's the free cash flow. And the discount rate is going to be a weighted average of the cost of debt. We're going to have a weight D, and we're going to multiply it by RD, the cost of debt, like the yield to maturity on the company's debt. And then we're going to take the weight of equity, and we're going to take that weight of equity and multiply it by the cost of equity, which is the required rate of return. So if this happens to be 6% is your cost of debt for your yield to maturity, and your cost of capital, your required return on capital is 12%, then, and let's just assume that we have 50% of our capital structure in debt and 50% of our capital structure in equity, then it just means our weighted average cost of capital will be 9%. So this is how you calculate the weighted average cost of capital. It's a weighted average. How much money, how much are you financing the company with debt, and how much are you financing it with equity? Here I'm showing you 50% of the dollar amount of debt is supporting the company, and 50% is supporting it with equity. And we're just multiplying out by the costs of each component, and we get a weighted average cost of 9%. So that's how we get this weighted average cost of capital. That's our discount rate. So it would be 0.09 in this case would be the discount rate here. So back to the free cash flow model here. Get back in black here. So if we have free cash flow grows forever, constantly, like I'm showing you here with the dividend discount model, but now it's free cash flow, it's going to be this. All the way out to infinity. And again, if the free cash flow happens to be zero initially for the first couple of years, let it be zero. We'll start and pick up the positive cash flows in year 3 and all the way out into infinity. And then obviously we have to, like we did with the dividend discount model, we have to truncate, come up with a horizon value to get rid of this infinity sign, because we know the infinity sign's a problem here and here. So we're going to have to come up with a horizon value, just like we did in the dividend discount model. So I think at this point the best thing to do is let's start jumping into a couple of examples and see how this works. So let's work an example. There's a lot of data to present in these types of examples. First off, we have EBIT in period 1, not 0, but period 1 is going to be $100. We'll assume the tax rate's 25%. The growth rate of free cash flow to infinity will be 4.5%. To infinity, and it'll be constant. There's no non-operating assets. That'll make it simple. The weighted average cost of capital is 10%. CapEx will be $25. The change in net operating working capital will be $5. Amortization and depreciation will be $15, and debt will be $200. And now we have enough information to solve this problem. First off, free cash flow is equal to EBIT 1 minus T plus depreciation and amortization minus CapEx plus the change in net operating working capital. So it's really, as I say in class, it's a plug and chug problem. You just plug the numbers in and crank it out. And so EBIT was given, so I'm using all this information up above. EBIT is $100. The tax rate is 25%. Debt, amortization and depreciation is 15. It's 15. CapEx is 25. plus the change in net working capital. So working capital increased. That means we need to invest a bit more in working capital, which means it's less free cash flow to investors. That's why there's a negative sign right here for that $5. And so when we estimate this is going to be free cash flow of $60. So at this point, let's do a timeline. And this goes out to infinity. So we're going to have $60 right here in free cash flow at time 1. So I could have given you earnings before interest and taxes at time 0, this guy at time 0, and you would have had to have grown it at 4.5% to get at this point, but I'm giving it to you, the problem gives it to you at time 1, just to make sure that you have the right timing here. And then this will grow by 1.04, and if we wanted to see the next free cash flow, it would be $65.52. So now at this point, but we don't really need that number, by the way. So at this point, let's value the company. It's going to be the free cash flow divided by weighted average cost of capital minus the growth rate of free cash flow. And we just plug the numbers in. 60. There it is, $60. It's 10% weighted average cost of capital given. Growth rate is given in this problem, 4.5%. The value of the whole firm, the left-hand side of the balance sheet. So here's the balance sheet. The value of the whole firm, company, is right here. $1,090.91. And we have $200 in debt, remember, right here. And so this guy has to be, let me scroll down and get some space here, $890.91. And what I didn't give you is the number of shares outstanding. Let me put it in purple here. The number of shares of equity stock outstanding, 40. Okay, 40 shares outstanding, so we divide this number by 40, and we get $22.27 for an estimate of the stock price today. So lots of information given, but sort through it and just literally plug the numbers in. Now it could be made more complicated. For example, we could give you the data for the weighted average cost of capital, and then you'd have to calculate it. But that's actually chapter 10. So in this chapter, we just literally give you weighted average cost of capital. We'll actually do the calculations in 10. We could give you the information to calculate free cash flow growth rates. But there's enough numbers in the problem to be worried about. So I want to give you the big picture of how it all works and how it all fits. You can always, by the way, in all these valuation models that I show you, you can always fine-tune your estimates. You can fine-tune your weighted average cost of capital, spend a lot of time looking at it. You can spend a lot of time estimating free cash flow and its growth rate. And that's what professionals do, but we just want to put together the model and get the big picture. Okay, so now let's do another problem. Example 2. Here is the information. EBIT at time 0 this time is $20. Weighted average cost of capital, 9%. T, the tax rate is 30%. Growth rate for free cash flow, first period. This is going to be, by the way, a two-stage growth model. 2 stages. So the first stage will have a 25% growth rate, really high. And then the second stage will be a more realistic 3%. And by the way, this first stage will be for the next 3 years. And then starting in year 4 to infinity, we'll get that 3% growth rate. Amortization and depreciation is $12 for the year. CapEx for the year is $10. change in net operating working capital, $3. Debt is 30. And shares outstanding, 17 shares. Okay, we have everything we need. So our free cash flow at time 0, because we're given, everything is actually in time 0. You can put little subscript 0 here, 0, 0, everything in zeros. And so free cash flow is going to be 30 times 1 minus the 30% tax rate plus the 12 in amortization and depreciation minus the $10 in capex plus the $3 in the change in net working capital, and we get $20 in free cash flow. So we graph it, and we get $20 right here. This has to grow by 25%, 25%, 25%, and then 3% forever. So multiply this by 1.25. We get $25 here in free cash flow, period 1. Multiply this out, we get $31.25 in free cash flow in period 2. Period 3, we get $39.06. And then we have to multiply this by 3%, and we get $40.23 for cash flow, free cash flow in period 4, that point 4. So what we need to do is we need to come up with the horizon value at this point, and that's going to be $40.23 divided by the weighted average cost of capital, 9 minus the 3% growth rate forever into the future, and this comes out to be $670.50. That is the value of the corporation, value of the company in year 3. So really what I did was I valued the company in year 3 is equal to the free cash flow in year 4 divided by the weighted average cost of capital minus the growth rate. And that's the growth rate that it goes to infinity. So always keep in mind, and this applies to both the dividend discount model and the free cash flow model, this number and this number are always one period apart. So if you're valuing the company in year 3, you need the cash flow one step ahead. Just like when we did this. We estimated a stock price using dividends. We estimated at time 0, we use the dividend 1 period ahead. If for some reason we're valuing something like 99 years out, then the price at year 99, an estimate, would be the dividend year 100 divided by RS minus G, if it was the dividend discount model. And the same concept for the free cash flow. This has to be one period apart, regardless of where you are on this timeline. So with that said, let me erase this and get back to discounting this guy. We got to discount this back at 1.09% for 3 periods, 1, 2, 3 years. And when we do that, we get a present value of $517.75. So the present value of all the cash flows starting at time 3 here, this point right here, all the way into the future, the present value of all those dividends is $517.75. Now we're entitled, the company is entitled to, the company is generating free cash flow all in these intervening time periods. So we're going to take 25 divided by 1.09. 31.25 divided by 1.09 squared, and so on. We get 22.94, 26.30, and $30.16. The whole thing comes out to be $597.15. That is the value of the company. Okay, that's the left-hand side of the balance sheet. Now we have to subtract off debt. And remember, debt here, debt is, where is it? Here it is, $30, and the number of shares are 17. So this is 597.15. This is 30. So this guy has to be 567.15 divided by 17 shares. And we'll get a price $33.36 for an estimate of the stock price today, time 0, using two-stage cash flow. And the cash flow is defined to be here free cash flow. So here we have a third example with some rather odd cash flows that I was referring to earlier. And let's look at the problem here. First, we have free cash flow at time 1 is -10. Well, it's not unusual to have negative free cash flow, especially when a company starts up. And then in period 2, we have 0 free cash flow. And then starting in year 3, we have $80 in free cash flow. And then year 4, starting in year 4, out to infinity, the growth rate is 3.25%. The weighted average cost of capital is 10%. Debt is 0, and we have 100 shares outstanding. Here's the timeline for the cash flows. And what we need to do now, so here's the -10, here's the 0, here's the 80. We need to grow this at 3.25%, and this comes out to be 82.60. And like we did before, we're going to value the company right here because this is where growth starts. Constant growth forever. And so we're going to take the 82.60 divided by the 10% weighted average cost of capital minus the 3.25% growth rate, and we get 1,223.70. Now we need to discount that back 1, 2, 3 periods. So 1.10 to the third power gives me 919.39. You don't have to worry about discounting this cash flow. It's 0. And this cash flow is basically minus 9.09. You take the -10 divided by 1.10 to the 1 power. Treat these cash flows, whether it's negative or 0, just like you would any other cash flow. Literally carry out the math. I'm not going to carry out the math for 0 because you know it's going to be 0. But the minus sign, the -10 cash flow here, it's going to come out to a present value of -9. That's going to detract from the value of the firm because you're losing some money. So it makes sense that it's going to have a detractor to the value of the company. So when we add this up, we get 910.30. And that's the value of the company at time 0. And so we're going to take that 910.30, subtract 0 in debt. The firm has no debt, all equity. And we're going to divide it by 100 shares. And then we're going to get $9.10 per share. That is the equity value of the company, $9.10. So there you have it. Even if you have some rather strange cash flows that you're not used to looking at, my suggestion is to literally just carry out the math as we normally do it, even with a negative sign and even with 0. And the negative sign does make sense because you know -10 cash flow, you intuitively know that's not good. It's going to detract from the value of the company, and then we have only $910 in the value of the company at time 0.